Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Understanding Yield Curve Analysis, a key to smarter investments. Factors influencing the yield curve. The yield curve is an essential tool that helps investors understand the bond market. But what shapes this curve? Let's break down the key factors influencing the yield curve. Central bank policies. Central banks, like the Federal Reserve in the U.S., play a pivotal role in shaping the yield curve. They control monetary policy, which includes setting interest rates. When interest rates change, the yield curve responds. Interest rate adjustments. When central banks raise interest rates, short-term bond yields generally increase. This often leads to a steeper yield curve. Conversely, when they lower rates, short-term yields drop, flattening the curve. Quantitative easing, QE. Central banks buy long-term securities to inject money into the economy. This increases demand for these securities, lowering long-term yields and flattening the yield curve. Forward guidance. Sometimes, central banks make announcements about the future path of interest rates. These signals can affect investor expectations and shift the yield curve even before any actual policy changes occur. Market sentiment. Investor sentiment and market forces are equally important in shaping the yield curve. How investors feel about risk and the economy can shift the curve dramatically. Economic outlook. If investors are optimistic about economic growth, they may expect higher future interest rates, which can steepen the yield curve. If they are pessimistic, the opposite happens, and the curve flattens or even inverts. Inflation expectations. Higher inflation expectations usually lead to higher long-term yields because investors want higher returns to compensate for the loss of purchasing power. Lower expectations lead to flatter curves. Demand for safe assets. During times of uncertainty, investors might flock to safe assets like government bonds. This increased demand can lower long-term yields, flattening the curve. Understanding these factors can help you get a clearer picture of the bond market and make more informed investment decisions. Next, we will explore more elements that impact the yield curve. Stay tuned. Limitations of yield curve analysis. Although yield curve analysis serves as a valuable tool for predicting economic changes, it has its flaws. Understanding these limitations can help you make better decisions when interpreting the signals it provides. False signals. Yield curves can sometimes give misleading signals that confuse rather than clarify economic conditions. Here are a few scenarios where this happens. Short-term anomalies. Occasionally, short-term factors like temporary supply-demand imbalances can cause the yield curve to invert when there's no actual recession looming. This inversion might scare investors unnecessarily. Policy distortions. Government interventions, such as quantitative easing, can distort the yield curve. These actions can artificially influence interest rates, leading to false signals that don't accurately reflect market conditions. Delayed reactions. Yield curve signals often come with a delay. By the time the curve indicates a recession, economic conditions might have already begun improving, meaning the curve's prediction came too late to be useful. Variability in economic conditions. Economic conditions are rarely constant. Variations can distort yield curve interpretations, making it harder to draw accurate conclusions. Inflation effects. High inflation can impact bond yields and hence the yield curve. Sometimes, yields rise not because of economic growth but due to inflation fears. This can mask the curve's true signal about future growth or recessions. Global influences. In our interconnected world, global economic factors can affect the yield curve. For example, a slowdown in major economies like China can influence U.S. yield curves, making it hard to isolate domestic economic indicators. Sector-specific changes. Economic conditions vary significantly across different sectors. A sector experiencing rapid growth or decline can skew the yield curve, leading to misinterpretations about the broader economy. By being aware of these limitations, you can approach yield curve analysis with a more critical eye, balancing it with other economic indicators to get a clearer picture. Conclusion. Yield curve analysis is a valuable tool in the world of finance. It helps investors and analysts understand the health of the economy and make informed decisions. By examining the shape and movement of the yield curve, we can gain insights into interest rates, economic growth, and potential risks. Key takeaways. Here are the key points from our discussion on yield curve analysis. Types of yield curves. Normal yield curve indicates economic growth and stable interest rates. Inverted yield curve often predicts a recession. Flat yield curve suggests economic uncertainty. Factors influencing yield curves. Monetary policy. Central bank actions can shift yield curves. Inflation expectations. Rising inflation can steepen the yield curve. Economic growth. Strong growth tends to steepen the curve. Economic indicators. Yield curves are used to forecast future economic conditions. They serve as a benchmark for other interest rates. Importance in financial decision-making. Yield curve analysis is not just for economists or financial experts, it's for anyone involved in financial planning and investment. Here's why. Investment strategy. Understanding the yield curve can help in choosing the right investment. For example, an inverted yield curve might suggest a shift towards safer assets. Risk management. It highlights potential risks, allowing for proactive measures. Interest rate forecasting. Yield curves provide clues about future interest rate changes, helping businesses and individuals manage debt more effectively. Practical applications. Yield curve analysis can be applied in various scenarios. Personal finance. Helps in deciding the right time for taking loans or mortgages. Corporate finance. Assists companies in timing their capital investments. Government policy. Aids policymakers in understanding economic trends and adjusting policies accordingly. Understanding yield curve analysis can make a significant impact on your financial decisions. It offers a clearer picture of the economic landscape and equips you with the knowledge to navigate it smartly. Keep these insights in mind, and you'll be better prepared to face the financial world with confidence. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.